Okay, let's try it.
All right. We're on the 15-minute Euro US, and we're going to start by doing a little historical study of this 15-minute chart. We take our Fibonacci retracement tool, and we come back to the low that I'm identifying here and go forward to the high. And we see that during this price increase, we had a fractal high identified at this level, and we retraced into the retracement channel between 38.2 and 61.8. The impulse corrective wave retracement theory tells us that we need to have price go back into that level before we can have some assurance that price will respond either positively or negatively to this high. So as we see, price begins to increase, and we have a candle right here. This is the first candle in the 15-minute period that closed full above the 5 level. This was the candle at which we could have entered a long position. In doing this, somewhere in that candle, the low was here, there was the high, close, excuse me, and there's the high. This doesn't leave very much room for profit in the 15-minute period, though we have dutifully followed the impulsive corrective wave retracement theory. Because entering on this candle, the first one below above 25, doesn't allow much profit before we reach another fractal high. There's 3 of them right here, really 4 of them. It's a quadruple top almost in a 15-minute period. So we know it's likely reached a high. So it would have been very difficult to extract profit from this trade using the ICWR theory. Now, let's apply that same strategy to the potential trade that we are faced with currently. We have a high right here. Here's our low. We theoretically will not want to enter a trade until after a candle has closed in this channel, 38.2 to 61.8. After which we will want to take a trade when a candle closes fully above 75 or fully below 25. Since in this period, the 15-minute period, it appears that this pair is in an uptrend, that is, the euro is going up against the dollar, it's most likely that we're going to be taking a trade somewhere above 150, 241 level. If we follow the 15-minute strategy, we have to watch the pair to find candles which comply with the requirements of the ICWR trade theory.
Now,
So,
you said that to take a short, it needs to close below the 25. Did you mean below the 0?
no, below the 25.
Because you've already had candles close below the 25.
Yeah, but no, not really. See, what we're doing is we're looking at this last down cycle. And there's the low. We won't have a close below the 25 level until we have candles that close above the 38.2 level, that is within the retracement channel. It's got to be within that channel, between 38.2 and 61.8. If price, for example, continues on down, then this channel was never entered. So we are still in the down cycle that was established way back here. That was the high, and we'll have to readjust the Fibonacci to reflect a lower price if price goes lower.
I see. So it's got to retrace.
It has to retrace.
Yeah.
We see that there has been this low, this fractal low, this fractal low, and now the third fractal low. And that happens at 854. Again, a very common retracement level as against this prior low back here. That's one of the reasons the ZUP 76 indicator is good, because it puts on our chart the actual retracement levels, so we don't have to continually get the retracement tool out to find out what those levels are. We know it tells us right there. So this is likely a good low. Probably we're not going to have prices below that, but it may go lower. It may test to 100. It may go clear on down to 100. The point is that if you trade the 15-minute time period, then you are mandated and compelled to wait until the events which justify the trade occur. So they have not occurred. We don't have price above 15 period moving average, still below it. We have to wait. So in this pair, we would turn away from it. It's not ready for a trade. We need to go find a trade someplace else. So we'll go look at the Swissy and see if there's a trade there in the 15-minute period. Well, we have a good run up, but it doesn't appear that we have a trade here either. But let's look at the historical record that presents in this chart, see if we could have made a profit in this one. We have a prior high, we came down and we made a fractal low right here. Price came up to the retracement channel. It came down to the low, made its low, came up into the retracement channel. Price started down again, and we have a candle right here closing fully below 25 level. So we would have taken a trade someplace within this candle. And if we had the misfortune of taking it way down here at the low, it would have been very difficult to extract profit from that trade. As you see, it didn't go much lower than that. Here was its low right here. And there was the ultimate. So that would have been a very difficult trade to successfully engineer. Now we're going to apply the same theory to the current, most recent upcycle. Come to the present high, and we see that we need to go into the retracement channel and only take a trade that closes below 75 or above 25 after having gone into the retracement channel. So this pair isn't ready for a trade in the 15-minute period unless you want to sit there and watch it all that time. So we'll go to the next one, pound dollar. Okay, here we go. On the 15-minute, we have no prior record to look at in terms of our analysis, so we'll make a, assuming that this is the low, and we don't know that, in fact, this is yet going to be the final low. It may come on down yet lower. But for purposes of this example, if this is the low, we only want to take a trade long when we have a candle that closes fully above 75. So we have a long while to wait in the 15-minute period to take a trade using the ICWR theory.
Now, wouldn't it, if it retraced to 38.2 or 50 and then started back down, that wouldn't, then you wouldn't have an opportunity to trade short until it goes below the 25. Is that correct?
According to the ICWR theory, yes.
Yeah.
Now, there is a way to short circuit, if you will, that strategy. And we see a way to do that in this particular example. If we decide that this is the correct low for this particular downturn, then if we enter a long trade, we should anticipate that the trade could go against us and that it will, in fact, turn around and come back down lower. So what we'll do is anticipate taking only 20 pips profit. Remember, we're dealing in a 15-minute period. So if we can pull out a 20 pip successful trade in this period long, then that is a successful trade.
And you
So
could
you have
you could use a tight stop because it would just be under that zero line there.
That's right. You would have a tight stop, 10 pips below it, and you would want to monitor it and seek to take profit arbitrarily at, let's say, 20 pips. Or you may want to let it run a little further. Maybe you'd want to try to get 30 pips out of that trade, or 40. But certainly if you take profit, let's say you entered 2 trades at that level. You would take profit on one at 20 pips and let the other run for 30 or 40 or however far it might go. So this is a way to not fully comply with the ICWR theory, but yet take profit out of the 15-minute period. But it requires the trader to accept a smaller profit potential in that trade, because you have to mandatorily leave the trade after you've taken your 20 pips, get out of it, and just be thankful for that profit and go on to the next trade. And if you put in 2 trades, then you could perhaps let it run to 30 or whatever it might go to. If you're going to trade the 15-minute period, that's a pretty good way to do it. That is, enter 2 trades and take profit at 20 pips, and then again take profit at 30 or at 35. And if it turns out that the trade goes back against you, then you move your stop loss to the break-even point on the second trade, so you do not lose money on the second trade. So it requires active participation and guidance by the trader to make sure that trade becomes those 2 trades become successful. It requires much more hands-on guidance and control than does the trades when you make them in the daily and weekly period. So if I were to trade this trade right now in the 15-minute period, I would enter 2 trades long. I'd set a 10 pip below this present level at 165.349, 10 pips below it, and I would expect to take profit 20 pips above the entry point of my first trade, and my second trade I would look for a profit 30 pips above that entry level. If the trade matures so that we make profit at the 20 pip level, I would immediately move my stop loss to a pip or 2 above break even or near break even, so I don't lose money on that second trade. That would be the way that I would handle a trade on this pair at this time in the 15-minute period.
Use your crosshairs and let's look at where 20 and 30 pips would be.
Well,
Yeah,
there's 25 pips.
Yeah. Okay.
There's 20 pips.
Okay.
Okay, so if you get 30, it's right on up here. Well, there's 30. So it doesn't have to move very far in your direction to be able to pull out of the market in the 15-minute period a 30 pip, two trades, one at 20 and one at 30.
Right click on your chart and let's see the indicators that you have there.
We use the Heiken ASHI version 2. That's a special custom indicator I posted to the boards on multiple occasions. The same is true of the support and resistance by Barry. I like that one because it tells me how long the fractal high or low has been in existence, how many time periods that it is in place. ZUP 76. I use the MACD cross signaler and the cross signaler backup. One pertains to, we'll first talk about the cross signaler. That is displayed with the yellow line, yellow arrows, and the cross signaler backup is the blue or the green, the smaller arrows. The larger arrows are the cross signaler, the smaller arrows are the blue arrows. The large arrows are indicating that the acceleration indicator has either gone above or below its zero line, whereas the other cross signaler indicates momentum above or below its zero line. I also use, as I said before, I like the simple moving average 15-day, a simple moving average based on the close, and it's in white. I like the stochastics indicator. The most commonly used numbers are 833. That works just fine, and that tells us likely what's going to happen to price. And we see here that in this trade, hypothetical trade that I've just made, we have the green line above red, suggesting price is going to move higher. We also have a green bar as our last 15-minute bar, which means that the present price is above its open. Also, we have a blue candle, HA candle. You can barely see it, but it's there, which suggests higher prices. Remember, we're only in this trade for 20, maybe 30 pips if we have two trades. So we're not going to get rich on this trade. We're just going to pull out a little bit of profit on two potential trades. For the trader that wants to monitor actively the trade, second trade, you can let that trade run, and it could well go well beyond 20 pips, run up 30, 40, 50 pips, quite a lot higher. If we have a retracement against this current downtrend, they most often occur in the 38.2 to 61.8 level. So we could conceivably have a trade that would permit in the second part of our trade a profit of, well, there's 100 bips right there if it goes up and tests the 38.2 level. So that's a pretty substantial trade in the 15-minute period. If it went on to test the 6.8 level, it's quite a lot higher. We're going to be 162 pips. So this is how a trader would use the 15-minute period with these indicators to make the trade. The most recent candle is the acceleration indicator going positive, right here with this green arrow, which means if we had the acceleration indicator on the screen, we would see that the vertical lines have closed above the zero line. That is an indication of higher price. So we go to the next pair. The pound yen, excuse me, the dollar yen. We can take a look at our prior record. Okay, here's an example of price decline that did not retrace into the retracement channel. That's the 38.2 to 61.8 level. Price continued on down, and once it breaks below zero line, that is an indication that we should be short that trade because that is a continuation trade. It wasn't a ICWR retracement. Those only occur when the price goes back into the retracement channel. This never happened in this trade. So if we were short, hypothetically, in this trade, we would want to continue to stay in that trade short and add to it once we have a candle closing below the zero line, which is this one right here. Once we get that candle closed below it, we add to that position, and that would have been a good trade in the 15-minute period, which would have generated, let's see, how many trades, how many dollars would we got out of that trade? Let's say we entered at the bottom of that candle to the next major fractal low. That's 390 pips.
Yeah.
Big trade. Further, and in regard to this trade, we see that when we had a period of retracement in this downtrend, that the green line came up, and though it barely went above the 60 line, it stayed well below the 80 and turned around and went back down